What do you think is the message now, as everybody's had the chance to digest yesterday's rate cut? At first, the market seemed upset that there wasn't more. Today, they seem to be saying, well, we think there still is going to be more in terms of easing. What do you say?
Yeah, I think yesterday's cut was really a take-back of the very controversial hike that took place in December. And essentially, the economy didn't need an interest rate cut at this point in time. We've had 4 consecutive months of increases in consumer spending.
Right.
4 consecutive months of increases in income. We had retail sales well above expectations in June. And in particular, online commerce was up 8.7% year over year, the strongest month thus far this year. So I think it's the consumer that's going to continue to drive the economy forward.
So you're in the camp that thinks, it looks relatively bullish out there. We didn't need this in the first place. Now that it's happened, does it make you sort of, is it status quo for you on stocks then? I mean, like you said, do you pick the parts of the economy you think are strong, like the consumer, and just stick with that? I
think it's part of that. I think the theme of slowing but growing continues. The underlying economic foundation is stable, but it's certainly slowing. So you have to identify quality companies, both on the equity side and the fixed income side. Stick to investment grade, stick to the U.S., we believe, on fixed income. Equities, companies with strong balance sheets, histories of earnings, and an entrenched management team.
And at least the U.S. companies still give you a yield.
Absolutely, especially when the 10 years yield is, what, 2%?
Right. So, Jeff, on that point, what is your takeaway from the Fed policy moves here? Are you upset they didn't do more? Like Kevin, do you think they've already done too much?
We think that actually what they've done is just about right. I think the idea of being data dependent, and after they started talking about perhaps cutting, going back a couple months ago, we've just gotten some very better than feared. I think BTF is like the new acronym that everyone uses, right? Better than feared data. And it doesn't support doing more than that. And I actually think that they would paint themselves in a corner if they promise. You can't promise. This is a data-dependent industry. So I think what they did was just right. I think the economy is moderating. It's not moving to recession. It's not so robust that we have to be worried about runaway inflation and rising rates that kills cycles like this.
Okay.
So we feel pretty good about this mosaic.
All right. So I guess you would keep Powell in his job if you had the power there.
I would.
You have a couple of stocks I want to mention so viewers know what we're talking about. You like Best Buy, for example, Micron in the technology space, FedEx in the industrial space. Are you not worried about the signals from manufacturing, which, while they haven't been disastrous, are slowing? I mean, that's the weakest, most vulnerable part of the U.S. economy, especially if we get another front in the China trade war.
So, when we really parse through even the manufacturing data, which is where you might have most caution, even Caterpillar, and we don't own Caterpillar, talked about strength in North America. So we also have exposure to domestic, trucking companies where we feel very good about things. On the semiconductor front, we feel very confident because they've been priced for recession. Expectations are so low, what they're saying is we're seeing a very slight cyclical uptick. And some of these semiconductor companies that we own also are leveraged to secular growth plays. Federal Express is just a great example of company-specific things that they've done to become more productive, upgrade their fleet, and e-commerce is a secular growth story.
Yeah, and I think it's interesting because it goes against the grain for some of the typical market narratives we're hearing around these stocks. Speaking of e-commerce, Kevin, finally to you, that's also an area where you see strength. I don't know if you can get specific, but how would you be buying here?
I think there's a lot of different companies that stand to benefit from the continued growth in e-commerce. Obviously, the Amazonification of the U.S. economy. Amazon's at the hub of that ecosystem. But you also have industrial REITs, the warehouses, the distribution centers, some of the delivery companies, a FedEx or a UPS or an XPO Logistics, and of course, other online merchant and providers. I think there's a lot of upside potential there. But again, I think you also have to look for those companies and those securities that offer income potential as well, even including municipal bonds or municipal bond closed-end
it's just nice to hear a justification other than Fed rate cuts for holding some of these stocks.